Here's a question. How does any business, whether it's a tiny coffee shop on the corner or some massive global company, actually know if it's winning? I mean, is it just about profit, or is it about getting bigger? It seems like a simple question, but the answer is, well, it's a lot more interesting than you might think.
The answer is, it has to have a system to keep score, right? A totally reliable way to measure what's going on, understand it, and then talk about its performance. Without that scoreboard, a business is pretty much just flying blind. And that system, that special language of business, is accounting.
All right, let's dive into this. In this explainer, we're going to look at the real objectives of accounting, and really how it takes all the potential chaos of business and turns it into something clear and understandable.
We're going to break this down into 4 parts. First, we'll tackle why accounting even exists in the first place. Then we'll figure out what makes financial information actually useful. After that, we'll explore the 2 different worlds of accounting. And finally, we'll get into the unspoken rules of the game that hold the whole thing together.
Okay, so let's start with the most basic question of all. Why do we even need accounting? What is the fundamental problem that it's actually trying to solve?
At its core, this is really what accounting is all about. It's a process, right? First, it identifies what's happening financially. Then, it measures those things in a way everyone agrees on. And finally, it communicates that info to people who need it. We're talking investors, managers, the government, so they can make much, much smarter decisions.
But hang on, did you catch that super important word in the definition? Useful? Not all information is created equal. So what is it that makes accounting data genuinely useful for making those big decisions?
Well, it really boils down to 2 key ideas: relevance and reliability. You can think of them as 2 sides of the same coin. For info to be relevant, it has to be able to actually change your mind about something. And for it to be reliable, you have to be able to trust it, to know that it's a true picture of what's really going on. You absolutely have to have both. So let's break down relevance. To be relevant, information has to be timely. I mean, getting last year's financial report today isn't going to help you much, right? It also needs to have predictive value. It should help you guess what might happen next. And it needs feedback value, which helps you look back and see if your old predictions were on the right track. Now, on the flip side, you've got reliability, and the ingredients here are just as vital. The numbers have to be verifiable, meaning another smart person could look at the same stuff and come up with the same answer. It needs to be faithful to what it represents, no smoke and mirrors. And maybe most importantly, it has to be neutral. The numbers can't be cooked to tell a certain story. It's all about unbiased truth.
Okay, so we know what makes information useful. But useful to whom? As it turns out, there isn't just one type of accounting. There are actually 2 completely different worlds, each serving a totally different audience.
And this chart just lays it out so clearly. Think of managerial accounting as the company talking to itself. It's for the managers inside the building. It's flexible, they do it whenever they need to, and it's all about planning for the future. Financial accounting, on the other hand, is the company talking to the outside world, to investors, to the government. It has to follow super strict, standardized rules. It only comes out a few times a year, and it's mostly a look back at what already happened.
But, for any of this to work, for either of those 2 worlds to make sense, everybody has to be playing by the same basic set of rules. The whole system is built on a foundation of assumptions and ideas, sort of like the unspoken rules of the game that everyone just agrees to. Let's look at the big ones.
First up is the Business Entity Convention. Now, this sounds fancy, but it's really simple. The business is its own thing, separate from its owner. The company's bank account is not the owner's personal piggy bank. This separation is absolutely crucial for keeping the books straight.
Next is what's called the going concern assumption. Basically, we all just assume the business isn't about to go bankrupt and shut down tomorrow. And that really matters, because it means we can value things like buildings and equipment based on how useful they are to the ongoing business, not what we could get for them in a fire sale. It's an assumption of stability.
Then there's the Money Measurement Convention. And this one's huge. The rule is if you can't put a price tag on it, it doesn't go in the official financial statements. It's that simple. This gives us a common ruler to measure everything. But as we're about to see, it also means some really important stuff gets completely ignored. All right, enough theory. Let's see how these rules actually play out in the real world. Let's imagine a company, we'll just call them Plastico, and see how they record a simple sale.
So here's the story. Back in February, Plastico gets a big order. Great news. Then, in April, they pack everything up and ship it out the door. But they don't actually see the cash until way later, in July. Seems pretty straightforward, right?
So here is the million-dollar question. When does Plastico actually get to count this money as revenue on its books? Is it in February, when the order came in? April, when the goods were delivered? Or July, when the cash finally hit the bank? What do you think?
If you guessed April, you nailed it. And this is all because of something called the Revenue Recognition Convention. The rule says that revenue gets counted or recognized when it's been earned and realized. That magic moment isn't when the order is placed or even when the cash arrives. It's when the company has done its part, delivered the goods, and is pretty sure they're going to get paid.
Okay, that makes sense for the money coming in. But what about all the costs? You know, the money Plastico spent to actually make all those products in the first place. When do those get recorded?
This is where another really elegant rule comes into play, the matching convention. And it's just a beautifully logical idea. You have to recognize the expenses in the exact same time period as the revenue they helped create. So all the costs to make Plastico's products get recorded in April too. That way, you get a true, honest picture of the profit from that one sale. So when you step back and you put all these pieces together, these objectives, these rules, you really start to see why people always say that accounting is the language of business. It's the shared vocabulary, it's the grammar that lets everybody, both inside and outside the company, speak the same language and understand what's going on.
But that brings us full circle, right back to that money measurement rule. If accounting only counts what you can put a price tag on, just think for a second about what gets left out. What about things like an amazing company culture, or your incredible brand reputation, or the genius of your team? It really makes you wonder, doesn't it? Just how much of a company's true value is never even recorded on the official scoreboard.